Hello, hello, can you hear me? Hello, can you hear me? Hello, can you hear my voice, sir? Okay, 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 okay. Okay, so welcome to all of you. So let's start the session. In the last session, we were discussing about the topic. We have done IFR 16 in the last class. So we are just going to start the session with this topic, that is sale and leaseback. Sale and leaseback. Sale and leaseback. Okay, sale and leaseback treatment has two impacts. The first one is the case in which the transfer is not a sale, and the second situation is where we have a transfer is a sale. So how we can identify that the transfer is a sale or transfer is not a sale? How we can identify this? You have to see this whether the company has still maintained the control of that asset, or the company has delivered the most of the control of the asset. So you can judge this value through the useful life of the asset. Assuming if the useful life of the asset is 10 years and the lease period after the sale and leaseback arrangement, it is also 10 years, that it means that the control is still maintained. So you can say this, that the transfer is not a sale situation. But if most of the part of the asset useful life has been transferred to the buyer and the company has a lease period of less than the useful life, then you can say that this transfer is a sale. Okay. So I'm giving you a question where you have to identify whether the transfer is a sale case or transfer is not a sale case. So you just read this situation, the first one I'm giving to you. Just read this situation and identify whether the company has delivered its control or the company still has retained most of its control. Kindly read the scenario and reply your answer in the chat box. Do the transfer is a sale or transfer is not a sale? You have to see this whether the company still has got the control of the asset or the company has delivered the control of the asset. I'm just reading this scenario. On 1st January, Stark entered the sale and lease back of its property. When it was sold, the asset had a carrying amount of 6 million and a remaining useful life of 10 years. Stark sold the asset for 7 million. The company has sold the asset with a carrying amount of 6 million for 7 million. The remaining useful life of the asset is 10 years and the lease period is also 10 years. Here, the most important point is the lease period is also 10 years. The annual installment is 1 million and the lease carried an implicit interest rate is 7%. Now, in this situation, you can say that the company has sold the asset and leased it back over a lease period of 10 years, which is also equivalent to the useful life of the asset. So then you have to decide the situation whether the transfer is a sale or transfer is not a sale. So the right answer is the transfer is not a sale because the stock still controls the most of the useful life of the asset. Now, what should be the accounting treatment for this? So we are going back. Now, here you can see the treatment. When the transfer is not a sale, you have to continue to recognize the asset. You cannot credit the value of the asset. You cannot de-recognize the asset and recognize the liability equal to the proceeds that we have received. So what should be the accounting entry for this situation? The accounting entry should be, I'm going to write here, we have to debit the cash that we have received, which is 7 million, and credit the value of 7 million. So what should be the accounting title that you should have to use? So new column here. Okay. The bank account should be debited and the whole amount received should be recognized in the loan account. So asset should still be recognized at a value of 6 million. Previously, we have been recorded the asset with a value of 6 million. So it is still recognized at the same amount. So you cannot de-recognize the value of the asset. Are you getting this point? Are you people getting this point? Yes. Okay. I'm repeating the situation again. In this situation, company has sold the asset having a useful life of 10 years, having a useful life of 10 years and lease it back to 10 years period. So that means that you have sold the asset, but you have leased it back to the same period of the useful life of the asset. So that means the control of this asset is still retained by you. So actually you have not yet sold the asset actually in substance basis. So that is why accounting says that you cannot de-recognize the value of the asset and the whole amount that you have received should be recognized in the loan account. But if The situation is a little bit different, where you can see the useful life is 10 years, but the lease period is 2 years. What does it mean? You have sold the asset having a useful life of 10 years, but you have just leased it back for a period of 2 years. That means the most of the control of the asset has been transferred. So if the control has been transferred, then that means the transfer is a sale arrangement. So in that situation, the accounting entry should be debit bank account, credit asset, and credit gain. So this is a normal entry that we have recognized when we sold the asset. And simultaneously we have leased it back. So the accounting entry will be debit right to use the asset, and the credit entry will be in the lease obligation. Okay. So this treatment will be made when the transfer is a sale. Control depends on the lease period and the useful life. So if the lease period and the useful life is approximately same, then it means the company has still retained the control. And if the lease period is substantially lesser than the useful life, then it means that we have transferred the control of the asset. Are you a right to use the asset? Okay. So now we are going to see the treatment. When the transfer is a sale, just read the treatment very carefully. The first line is de-recognize the asset. Number one. Second, recognize a right to use the asset as a proportion of the previous carrying amount that relates to the right retained. Again, I'm reading the scenario. Recognize the asset first. Second treatment is de-recognize the asset. Second treatment is recognize the right to use the asset as a proportion of the previous carrying amount that relate to the rights retained. Recognize a lease liability and a profit or loss on disposal will arise. So all you need to do is to, so the question is, if the lease period is higher than the useful life. If the lease period is higher than the useful life, then it means the company still controls the asset. So it's all about the control. And control means the overall useful life of the asset. So if the useful life is less than the lease period, then it's fine. That means the control is still retained by the company. But the point is, when the lease period is substantially less than the useful life, then you can say the control is transferred. And in that case, we have to recognize the transfer as a sale arrangement. Okay. So I'm giving you the question and you are required to solve this one. Now, first you have to identify whether in this situation the transfer is a sale or the transfer is not a sale. You have to identify whether the company is still controlling the whole of the useful life of the asset or the company has transferred the control. Transfer is a sale arrangement. Very good. Wonderful. Wonderful. You guys are doing very well. So how you people have identified this? Because the lease period is substantially lower than the useful life. And it means that the company has transferred its control and the transfer is a sale arrangement. Very good. So now we are going to make the accounting entry for this. Just do remember this point. You have to recognize these two accounting entries at the same time. So when we combine these entries, I'm locking this in a particular box to make sure you, when we combine these two entries, what will be the accounting treatment? We have to debit the asset, sorry, bank account. We have to debit the right to use the asset. The credit entry will be made in the asset account that we have sold. The credit entry will be made in the lease obligation account, and there will be a gain on disposal. So all of you are required to fill these boxes based on the question. All of you are required to make this accounting entry based on the question. I'm mentioning you here. I'm showing the question here. Yes, we can also have a loss on the sale. Please check this. Please read this question very carefully and please read the question and write your answers in a double entry form. I'm showing the double entry to you guys. This is the double entry that you should have to make. You can download today's handout from the handout section. Gain on disposal is 280. So some people have identified the gains. 400 gain. Will we get the recording of these classes? You will get the recording of these classes through the email that you will get in a day or two. Okay, I'm showing the question again. Should I solve it? Yes. Now, the question is saying on 1st January, slide show sold a property for its fair value of 2 million, transferring the title of the property on that date. Slideshow then lease it back under a 5-year lease terms. paying 1,50,000 per annum on 31st December each year. The present value of the rentals payable was 600,000 and the interest rate implicit in the lease was 8%. The carrying value of the amount of the property is 1.6 million and it had a remaining life of 20 years. Okay. So first we have to see, we have sold the asset having a carrying amount of 1,600. So this asset should be credited. And we have sold it for at a value of 2,000. So apparently when you see these two values, you will find a gain of 400,000 on this disposal. But the lease arrangement creates a lease obligation of 600. So you have to identify these two values. First one is the gain and the second one is the right to use the asset. Now what IFRS 16 says about this particular value? Please read it very carefully. IFRS 16 says recognize a right to use the asset as the proportion of the previous carrying amount. So you have to recognize the right to use the asset as a proportion of the previous carrying amount. So previously the value of this asset is 1,600 and we have retained a percentage of that asset after sale and lease back arrangement. So you have to identify what percentage we have retained after the disposal. So now we are going to calculate the percentage of the asset that we have retained. Now check this value. Currently you have sold the asset for 2,000 and after the lease arrangement the lease obligation is 600. So what percentage that we have retained? So 600 divided by 2,000. So it means that we have retained the 30% value of the asset that we have sold. So we have sold the asset having a carrying amount of 1,600. So the 30% value of this portion will be 480. So once you got these two values, the last one will be the balancing figure. So this amount plus this amount minus this amount and this amount. So the gain on disposal will be 200. I hope I have cleared the point. Okay, I'm repeating the point. I'm repeating this 480 again. First I'm deleting this value. Now, from the market perspective, just see these two values. Currently, the market value of this asset is 2,000 because we have sold it for 2,000. And the lease obligation that we have been created is 600. So from the market perspective, we have sold this asset for 2,000 and retained 600 portion of the total value. So when we calculate the percentage, that what percentage that we have retained, we have to divide 600 by 2,000 and we got the value of 30%. So with reference to the market value, we have retained actually 30% of the amount. So of what amount? So previously the asset has a carrying amount. We are not talking about the market value. We have to see the carrying amount of the asset. So previously the carrying amount of this asset is 1,600. So we have retained actually 30% of this value. So the 30% of this value will become 1,600 into 30%. And the balancing figure will recognize the gain account. So if you are still confused, you will get the recordings today. It might be possible that you will not be able to grab this point, but you will be having a recording. Cannot, because I cannot repeat a single concept many times. So if you are still confused in it, you can take my video and see it as many times as you can. Or you all have got my WhatsApp number. If there is something you wanted to ask, you can ask me directly on the WhatsApp as well. Okay. So moving towards the next point. So finally, we have covered IFRS 16. Now we are moving towards the topic IFRS 15 actually. IFRS 15 means revenue from the customer contract with the customers. So when and how to recognize the revenue is the overall subject of IFRS 15. So previously we have two accounting standards. One is IAS 11 and the other one is IAS 18. And IFRS 15 is actually uh, obsolete these two standards, and it's now ruling on the world. IFRS 15 is basically on principle-based approach. Previously, we have two accounting standards, IAS 11 and IAS 18, which are based on the rule-based approach. But IFRS 18 is now on the principle-based approach, having 5 principles through which we have to recognize each and every contract. So the first rule is to identify the contract. In all the situations, first we have to identify whether there is a contract exists or not. The second point is identify the performance obligation. We have to identify how many performance obligations that are present in the contract. Suppose if I say you that I'll be teaching you the tuition fee, I'll be teaching you the tuition of paper FR along with the books will be provided to you free of cost at a price of suppose 8,000. So I'm charging you the price of 8,000 and I'm giving you two sort of performance obligations. The first one is the service, which is the tuition, and the second one is the goods, which is the books. So if I'm providing you the tuition and the books simultaneously at the price of 8,000 or 10,000 or 15,000 pounds, whatever be the price. So IFRS 15 says you have to identify how many performance obligations are present in the contract. So there might be one performance obligation in the contract, it might be 2 or 3 or 4, it might be more than 5 performance obligations. Determine the transaction price. Then we have to identify what will be the contract price. Then allocate the transaction price to the performance obligations. Then we have to allocate the transaction price, break the transaction price into different performance obligations value. And finally, recognize the revenue as when the performance obligation is satisfied. So here we have got the 5 points. These are called 5-step approach. I'm repeating the points again. First one is identify the contract. The second one is identify the performance obligation. Third one is the transaction price. Fourth one is allocate the transaction price to each performance obligation. And the fifth one is recognize the revenue when the performance obligation is satisfied. So we have different cases for IFRS 15. So let's start with the first situation. This is called financing component situation. In this situation, you will find a sale in which the company has made a credit sales and the credit period is a substantial period in which the time value of money is relevant. Suppose the normal terms, normally the seller give the credit to its customers, in fact the valuable customers, some credit of 20 days, 30 days, 40 days, or maximum 2 or 3 months. At maximum, the supplier gives you the credit period of 2 to 3 months. But if the customer is negotiating with you a longer credit period, like 2 years, 3 years, I will make the payment after 4 years. So that means the price that should have to charge will be different. Like you are buying a car from me right now and paying the full amount in cash. The amount of the car is assuming is 5 lakh. But if you're purchasing the same car from me with negotiating a time period of 2 years, that you will pay the whole amount after 2 years. I'm delivering the car right now. I'm giving the car right now, but you will pay the amount after 2 years. So that means IFRS 15 says that you are delivering two things. The first one is the goods, which is the car, and the second one is the service, which is the financing. So we have to allocate the transaction price between the value of the goods and the value of the service. So let's discuss on this tab. So suppose you are purchasing a car from me right now and paying the whole amount in cash. So the price is 600,000. But if you are purchasing a car from me and asking for a credit period of 2 years, that you will pay the amount after 2 years. So might be I will charge amount of 800,000 from you. So IFRS 615 says that in this situation, you are actually delivering two things. The first one is the car and the second one is the service. What type of service you are providing? What type of service you are providing? Actually, the service you are providing is the credit facility. It is actually the credit facility you are giving to the customers. So IFRS 15 says that you have to break the price of 800,000 into the value of the goods and the services. So what will be the price of the goods and the services in this transaction? Because I have to give you the credit facility, my first performance obligation is I have to give you the credit facility. And the second performance obligation is I have to deliver you the car. So I have to break the price into two parts. So 800,000 price should be broken down into the value of the car and the service. So how we can calculate the value of the car? The value of the car will be the present value of future cash flows. The present value of the future cash flows will be the value of the car, and the remaining difference, the balancing figure, will be the value of service. Assuming the discount rate is 10%, discount factor is 10%, that is the time value of money impact, and assuming you have calculated the present value of this car is 800,000 into 0. The second is discount factor is 0.826. So the present value of the future cash flows is 6,60,800. So this is actually the value of the sale of the car, and the remaining difference will be the value of the service. Sorry, I have added these two figures, actually subtracted. So out of 800,000, 1,39,200 is the value of the service, and 6,60,800 is approximately the value of the car. So we have to recognize the revenue only when we have delivered the performance obligation. So do remember this, that the value of the service will always be recognized at the end of the time period. And the value of the car will be recognized immediately. So suppose if you have delivered only the car on the credit terms, so the accounting entry will be cash debit by this amount, sorry, receivables debit by this amount, Receivables debit by this amount, and the credit will be the sales amount, because we are doing a business of selling a car. So the car is actually my goods. So by the end of the year one, we have to recognize the finance income. Receivables debit and credit will be the finance income. So we have to credit the value of the finance income, which will be the portion of this amount. Now, how we can calculate the portion of this amount? It will be the percentage of the present value. So 6,60,800 will be the first year's finance income. So what we have done, we have broken down the value of the car, 800,000, into two parts. The first one is 6,60,800, which is the value of the sale of a car, and the second value is 1,39,200, which is the value of the credit facility. So we only have to recognize the value of the credit facility when we have delivered the service. So I hope I have cleared this point. FI means finance income. So I'm just sharing you the question. I want you guys to attempt the question and reply your feedback and reply your answers. I'm just giving you the question here. Where is the question? Okay. The second entry is receivables debit and finance income credit. Finance income amount is calculated as a percentage of the present value. So this is the question for you guys. Try to attempt it based on my explanation. I'm giving you just 1 minute to solve it. Okay, do you people want me to solve the question? Yes. Road company enters into contract with a customer to sell equipment on 31st December 2001. Control of the equipment transfers to the controller on that date. The price stated in the contract is 1 million and is due on 31st December 2003. So the transaction will take place at 31st December 2001, but you have to make the payment after 2 years, 2002 and 2003. The market rate of interest is 10% and the value is 1 million. So now let's start the question. Here you can see the value of the equipment is 1 million. The time period is 2 years. In fact, the present value will be 826,000 and the value of the service will be 1,74,000. So the receivable will be debit by 826,000. Sales will be created with the 826,000. And this accounting entry that we have to made in the year 2001. 31st December 20x1. But by the end of 31st December 20x2, we have to recognize a finance income of 826,000. And for the last year, 31st December 20x3, the accounting entry will remain the same, debit and credit, receivables debit, finance income credit, we'll be taking the 10% off this amount plus this amount into 0.10, 10%. So this will be the finance income for the second year. So if you add these two finance income of the 2 years, you will get the value of this total service, which is equal to 174. Okay, is that clear to all of you? Eight to 6,446. It's actually the round of figure that I have calculated. Usually, examiner will give you the discount factor for the calculation. So 8 to 6. Second year's discount factor is 0.826. So I have just multiplied the figure, and as I have taken only 3 decimal points, so that's why my answer is a little bit different from you guys. So for the first 3 digits is same, and the remaining amount will be the balancing figure. Now, any question from you guys? Yeah, 0.826 is the second year's discount factor. Any question? Is that clear to all of you? Okay, I'm telling you the second and third year in a little bit more detail. So if you're confused with it, you can make a table for this. For the year one, the receivables at the start of the period is this amount. Then we have to book a finance income into the percentage, which is 10%, 0.10. And you are not going to receive any payments, receipts in this year. So at the year end, your receivable figure will be this amount plus this amount. So when we are going to make the second year's finance income, the receiver at start will be this amount, and we have to take the interest based on this figure. I think you people are getting this point. So for the last year, the amount will be approximately equivalent to last year the amount will be approximately equivalent to 1 million. You can check it. The amount is approximately equivalent to 1 million. So the difference of approximately 540 is due to the rounding of difference. So I think I have cleared the points. Is that clear to all of you guys? I'm moving on towards the next concept. The next concept is the allocation of the transaction price. So how we can allocate the transaction price. So I'm giving you the example here. Suppose if the company is selling goods and services, separately at a price of, suppose 9,000 is for the value of the goods and 6,000 is for the value of the service. So the total price of these two products will be 15,000. Is that clear? Suppose the value of the goods is 9,000 and the value of the service is 6,000. The total price will be 15,000. And we are selling the goods and services at a price, the combined price of, at a discounted price of 12,000. So at a price of 12,000, we are selling the goods and the services both in the same price. So IFRS 15 says then you have to allocate this transaction price 12,000 into the value of the goods and the value of the services proportionately. So how we can calculate the value of the goods and services from this 12,000 figure? These two figures are unknown for us. So exam standard says that if you have been given a standalone selling price of the goods and services, standalone selling price, then take the percentage, weighted average percentage of the value of the goods and services. So what is the value of the percentage of the goods? 9,000 divided by this 15,000. So out of the total bundle of 15,000, the value of the goods is actually 60%. and the value of the services is 40%. If we convert it in percentage, it will be 60%, 40%. So how we can calculate the value of the goods from this 12,000? You can take the 60% of this 12,000. So 7,200 will be the value of the goods, and the remaining amount will be the value of the service. Sorry, mistake. This amount 12,000 into 40%. So this is how we break the goods and the services. Actually, it's converted in percentage. The cell has got a problem. 12,000 into 40%. Okay. So 7,200 is the value of the goods and 4,800 is the value of the services. The value of the goods will be recorded when we have transferred the goods. It will be recorded immediately. But for the value of the services, it will be recognized only when we have delivered the service. So if the service period is, say, for example, 2 years, then this service value will be broken down into 2 years. So by the end of the first year, 2,400 will be recognized, and the same amount will be recognized in the second year. So this is how we deal the questions with standalone prices. So the value of this, the name of this topic is allocation of the price. I'm sharing you just the slide of this question. So you are required to calculate the price. So you have 1 minute for the calculation. Please solve it. Yes, is it done? Should I solve it? Shirt company sells a machine and 1 year's free technical support of $1,20,000. It usually sells the machine for 1,20,000, but does not sell technical support for this machine as a standalone product. Other support service offered by the shed attract a markup of 50%. It is expected that the technical support will cost 20,000. So machine and 1 year's free technical support. So the value of the machine is 1,20,000 in total. This is the total price in which you will get the machine as well as support. So usually the machine will be sold at a price of 12,000, 1,20,000. Yes, and service will cost you 20%. So actually the cost of the service is 20,000. So what will be the selling price if the markup is 50%? So the sales price will be 20,000 divided by 100 multiplied by 150. I hope your people are getting this point. So value of the support will be 30,000. So actually if you sell these two products separately, the value of the goods and the services will be 1,50,000. So at a price of 1,50,000, we are selling machine and support at the same time. So what will be the percentage of the machine? So it's 80% for the machine, and support service will be having a value of 12,000. So the total price that we are charging right now is 1,20,000, out of which the machine is having a value of 80% and the support service will be having a value of 20%. So how we can allocate the price? 1,20,000 into 80% and 1,20,000 into 20%. So this is how we break up the price. Wonderful. There are some people who have done it very correctly and rightly. So right now, if you have any question about this, you can ask it immediately. Are you people are getting this point? The question is mentioning here the cost price of the service that we offered is 20,000. So it is actually the cost that we have incurred in order to provide the service. And we are selling our service at a cost plus 50% markup. So we have extrapolated this price by dividing 20,000 by 100, which is the 100% value. And we are calculating the 150% value, means cost plus profit 50%. So we are extrapolating the value of the sale from the cost price. So actually the value of the support service is 30,000. So standalone support price is 30,000. Standalone the value of the machine is 1,20,000. So the total figure will be 1,50,000. So when we divide 120,000 by the total price of 150,000, we got the value of 80%. So in a total bundle, the value of the machine is 80% and the value of the support is 20%. So now we are allocating this price of 1,20,000 into the value of machine and support. So 80% will be allocated to the machine and 20% will be for the services. How to calculate the entry factor by yourself? There is no need to know about the entry factor actually for this paper. Entry factor is useful for paper F9. But if you wanted to ask from me or want me to explain you can WhatsApp me personally. I will tell you how to calculate the entry factor. But for this paper, whenever examiner will give you the question, examiner will always give you the discount factor for the multiplication. I think you people are getting the point. That's good. So let's move towards the next area of IFRS 15. So the next slide will be for the construction contracts. Yes. For the construction contracts, IFRS 15 says that for all the construction contracts, first calculate the total revenue of the contract. Suppose it is 100 million. Then calculate the total cost of the contract. Suppose it is 60 million. So you will get the total profit, which will be 100 minus 60. Then identify the percentage completion. Suppose in year 1, your contract is 20% complete. And in year 2, your contract is 50% complete. So you have to calculate the percentage and recognize the revenue and the cost based on the percentage of the work we have done. So if the total price revenue is 100 million, total cost is 60 million, total profit is 40 million, and in the year 1 we have done 20% of the work, then it means that we can recognize the revenue of 20% of the revenue. We can recognize the cost at 20%. And finally, we got the profit by taking the difference between these two values. So if my contract is 20% completed, that it means that we can recognize the revenue of 20, cost 12, which is the 20% of the value of the total cost, and the 20% of the profit. Is that clear to all of you? Is it clear? Now, based on the information you have been provided, calculate the revenue, cost of sales, and the profit for the second year. From this scenario, calculate the revenue, cost of sales, and the profit for the second year. I'm just repeating the point. Suppose in year one, we have calculated the percentage of 20%, means my contract is 20% completed. Then we can book the 20% of the revenue for the first year, 20% of the cost, and 20% of the profit. This is what I have done. So 20% of the revenue will be 100 into 20%, 20. 20% of the cost will be 60 into 20%. So you have to book everything at the percentage of 20%. So 20, 12, and 8. So this is the value for the first year. I am giving you the assignment to calculate the value for the second year. So what will be the revenue, profit, and cost for the second year? Now do remember this point. If the company has done a 20% work in year one and then 50% in year two, then it means that the 50 is the percentage for the 2 years. It's not actually the percentage for the second year. It is actually the cumulative percentage for the 2 years. So practically speaking, in year two, we have actually done 30% work, because 50% is the total cumulative percentage for the first and second year. So in the first year, we have already done 20% of the work. So on an incremental basis, we have done 30% of the work in year two. So we can only book 30% of the revenue for the year two. 30% into of the revenue, 30% of the cost, and similarly 30% profit. I hope you people are getting my point, that we are booking the percentage of the work that we have done in the second year. So 50 is actually the cumulative figure for the 2 years. So we have to take the difference, that how much incremental work we have done in second year. So in the second year, we have done actually 30% of the work. So 30, 18, and 12 is the right answer. Are you people are getting this point? Yes. No, we never use the actual cost incurred for the income statement. It will be used in the balance sheet only. Now, okay. The next point is how we can calculate this percentage. So we have two approaches. The first one is the cost approach, and the second one is the work certified approach. In the cost approach, we use the formula cost incurred divided by total cost. So this is how we use the cost incurred approach. This is also called input method. And work certified approach is also called output method. In this situation, we take the work certified to date divided by total revenue of the contract, the total price of the contract. So the cost approach is actually calculating the percentage based on the cost incurred to date, and the work certified approach calculates the percentage based on the revenue that we have earned during the period. So these are the two approaches. Examiner will give you the approach to calculate the percentage of the question. Does not give you the percentage. Mostly in the exam question, examiner will provide you the percentage, but if this percentage is not given, you can calculate the percentage with any of this formula. But examiner will tell you the approach that they follow. Okay, so here I'm giving you the question. All of you are required to solve it and give your answers. You have to calculate the revenue, cost, and the profit that we have to book in the first year. First based on the input method, and then second on the output method. Two handouts are available in the handout section. If you want the notes or the slides, you can download the data. Some people want my number. I'm just sharing my number. How can we download it? You can see on the screen on the right hand side, the portal of GoToWebinar, you will see a handout section. Just above the chat box, there is a handout section. You just click on the handout section and you will find two handouts. One is my lecture slide and the second one is the practice handout. The recorded lectures will be given to you very soon. Management will provide you the lectures in a day or two. In this question, you are required to calculate the revenue, the cost, and the profit, first using the input approach and then using the output approach. Okay, very good. We have received one answer from the student side. I want all of you to please do attempt this question and reply your answer in the chat box. Please try to attempt this question. Believe me, if you follow all my instructions, you will definitely pass paper. There is no one who can stop you in passing the paper if you follow all my instructions. I have a unique and different plan for those who was previously flunked in this paper one time or more than one time. So if you previously got flunked this paper or have some issues in passing the paper, if I have some different tips for you guys. Just contact me personally on the WhatsApp. I will provide you the plan that you should have to follow if you wanted to pass the paper. But for those guys who are giving the first attempt, you have to follow the standard plan. But who the guys who have got flunked previously, I have a special plan for those people. So I think yeah, I have created a WhatsApp group. I have shared my number. So those I have shared the link today, and I think number of students have already joined the group. So those who wanted to join the group can just WhatsApp me, and I will provide you the link. So do you people want me to solve, or you have done it? So the total cost that we have incurred to date is 300,000. The price is 500,000. Estimated cost to the completion is 100,000. So when we are going to calculate the total cost in this question is 5 lakh, and total cost will be 4 lakh. So the total profit is 1 lakh. Yes. So we have two methods available. The first one is the cost approach, and the second one is the work certified approach. The cost section, we have been given the cost incurred to date is 300,000 out of the total cost of 400,000. So the percentage in this case is 75%. What about the work certified approach? The work certified to date is 400,000 out of 500,000. So the percentage is 80%. So is it our first year? Yes, it's our first year because there is no data of the previous year. So when we are following the work certified approach, the cost incurred approach, we can book a revenue of 375, 300, and 75,000 profit. But assuming the percentage is 80%, then the revenue will be 400,000, the cost will be 3,20,000, the profit will be 80,000. Please check your answers. Is it done? Input method means the cost that we have incurred to date. So the total cost that we have to incur in the project is 400,000, and out of 400,000 we have already incurred the cost of 3 lakh. So the proportion of the cost that we have incurred out of the total cost is 75%. So this is how we have calculated the percentage. 80% is not an accumulated percentage because it's not a second year. Whenever we have second year, then we will be having a problem of accumulate percentage. How we recognize the total cost is 400,000. It was given the question that the company has currently incurred 300,000 and the estimated cost to complete is 100,000. It means the total cost that the company is going to incur will be 400,000. So right now company has only incurred 300,000, but 100,000 has yet to be incurred in the future. Is that clear to all of you? Okay, that's great. Now, what about the balance sheet approach? When we're preparing the balance sheet for this situation, first we have to take the cost incurred to date, cost incurred, then we have to add the total profit, then progress billing should be deducted from there. So cost incurred to date plus the profit figure less the progress billing. So the final amount, if it comes with a positive sign, then it means it is a contract asset. It should be reported in current asset. But if the answer is negative, then it will be a contract liability. PB means progress billing. Progress billing. Progress billing is the amount that we have billed to the customer, and after that the customer will pay you the payments. So here we have a question for you. How should the above contract be reflected in the financial statement of named company for the year ended 31st December 2004? So all of you are required to solve this question. You have 2 minutes to solve it in 31st in the financial statements for the year ended on 31st December 2004. The time is over now. So there are a few students who have solved the question. So I'm going to solve it by myself. The total price of the contract is 30 million. The total cost incurred will be 21 million. So let's solve it. Now here we have a total revenue is 30 million, 30,000. The total cost will be 21 million. So the total profit will be 9,000. Now, the question says that the percentage will be the input method. Input method means you have incurred 14 million out of 21 million. So the percentage calculation is 67%. So if the 67% contract is completed in the first year, then it means that we can recognize a revenue of 20,000, cost of 14,000, and the profit is 2,000. Now we are making on the balance sheet. In the balance sheet, the cost incurred to date is 14,000. The profit that we have earned to date is 6,000. And the progress billing is 12 million. The amount of the contract asset will be 8,000. Very good. So there are a few people who are doing the question very correctly, very rightly. Progress billing means the amount that we have billed to our customers. And after that, you will get the payments. So if you have been given a payment, that means that this is the amount that we have already billed. So any confusion from the student side, you can ask it immediately. Do you people have any confusions? Uh, 67% of 9,000 means yeah. Balance sheet we always use cost incurred. Okay, let's solve the question. The question says that we have incurred 14,000 the cost of 21 out of 21. So it means my contract is 67% complete. So if I multiply 67% here, and you got the value of this figure, 20,100. Yes, this is the right figure. So what error this has made? It's a computer's error. Actually, it has done some rounding of errors. It's not my issue actually. So this is actually the right figures: 20,100, 14,070, and 6030. Okay, 14 divided by 21 is actually 66.67%. So the computer has done the round off, and that's why the figures are slightly different. That's fine, just has nothing, no issues. So are you people are getting these concepts? What is onerous contract? I'm not teaching IS 37 right now. I will tell you, you don't have to worry about onerous contracts. Just follow whatever I'm teaching right now. When rounding off is necessary, you can do the rounding off. Yes. In the financial statements, in the revenue section, you have to add the revenue figure. In the cost of goods sold section, you have to add the cost of goods sold. And in the balance sheet, current asset, you have to report the contract asset. If you use the computer formula, it would round up and then it will calculate the contract asset. We are supposed to deduct. Amount received will always be the progress billing, will be the question with the same level of more in depth. No, the examiner will give you the questions with the same depth. There is no in-depth requirement for this paper. Progress billing is the amount that we have billed to the customer, and after that the customer will pay you the cash. So if the question says that the company has received the cash, that means that this amount will be equal to the progress billing. Okay. Progress billing means the amount that we have charged to the customer, that we have billed. We have sent the bills to the customers. This is called progress billing. What should we take for the calculation of the contract asset? The contract assets, first we have to take the cost incurred, then we have to add the total profit and less the progress billing amount. So when we deduct the progress billing from the cost incurred to date and the profit, you will get the contract asset. If the value is positive, then it means it's a contract asset, and if the value you will get is negative, it will be contract liability. 67%. 67% is simply the percentage that we have calculated based on the cost incurred today divided by total cost. The cost that we have incurred is 14 and the total cost is 21. So approximately check this, that 67%, actually this percentage is actually not exactly, it's actually 66.67%. So that's why the values are slightly different. Check this one again. When I am taking it in more than one decimal places, the actual percentage is not 67%, it is actually 66.67%. Computer is taking a rounding off data. So when you take 66.67%, so the amount will be this figures. And if you take exactly 67%, the amount will be slightly different. But you don't need to worry about the exam, because the examiner will give you the accurate percentage. So it will be something around 50% or 80%. So there will be no confusion for the ambiguity for the rounding off. Okay. So it's an online session. If you wanted to take break, you can take a break. But it's my recommendation to take all the stuff along with you. If you want to eat something, if you want a tea, if you want a coffee, whatever you want, just take it along with you and uh, try to eat during the class because we don't have the luxury to take the breaks because in the last day we have it's been almost 1.5 hours which has been wasted because of technical issues and some other issues. So I'm trying to cover my syllabus. So do you people up to now, what's the feedback of yours of this session? Do you people are getting any benefits from these lectures, these practice sessions? Do you think that we are going in a fast pace or we are going very slow? Because I'm trying to make my speed at the level of the students. Because, but if you think that I'm going a little bit slow, I can go more faster. And if you're thinking that my speed is a little bit fast, then I can be a little bit more slower. So mostly the students are saying the speed is reasonable and the session is in fact helpful. So that's why I have started from the new standards, which is IFRS 16. And then right now we are covering IFRS 15. After that, we will be covering the financial instruments topic, IFRS 9 and IS 32. Then we will go on the taxation area. Then we will cover different areas. I will try to cover the most important and the significant IFRSs that are examined, but it might not be possible to cover the whole of the syllabus. So I cannot go in that speed that you will find that you are enjoying a bullet train. So one more thing that we have to learn from this topic, construction contract. Suppose if the contract is loss making, assuming the total revenue is 30,000, the total cost will be 35,000. Total revenue is 30,000, and the total cost will be 35,000. And the contract is a loss making contract. Then in this case, IFRS 15 says you have to recognize the whole amount of the loss in first year. Loss cannot be proportionated like we do for the profit. You can proportionate the profit figure, but we cannot proportionate the loss figure. So the whole loss should be recognized in year one. The whole of the loss should be recognized in year one. So this should be placed here directly. Now, if my contract assuming is 50% completed, if my contract is 50% completed, then I can book only revenue at 50%. But the cost figure will be the balancing figure, will always be the balancing figure in case of loss. So what should be the balance amount if the revenue is 15,000 and there is a loss of 5,000? So the balancing figure will be 20,000. So if the revenue is 15,000 and the loss is 5,000, then the cost will be 20,000. So this is how we solve the loss making question. So yes, we are following the prudence concept, and prudence says that the losses should be recognized immediately and the gains will only be recognized when realized in monetary terms. So we are actually following the prudence concept and recognize the whole of the loss in year one. Is that clear? No, it will be shown as a contract liability. No. If the financial statement amount is negative, it might be possible it will get positive answer. You will get a positive answer. But if the final answer of the balance sheet figure is in negative, then it will be reported as a contract liability in current liability. Now, this is the question for you for the bundle transaction in which you people are required to solve it. The year end of the company is 30th September 2009. So all of you are required to solve it. The year end of the company is 30th September 2009. I'm just giving you 1 minute to solve it. And write your answers in the chat box. Now, what is the answer? The year end is 30th September 2009, and you are required to solve this question. What amount of the revenue should have to be reported on the face of the income statement? Do I have to solve the question? It's not in here, but I'm telling you the year end is 30th September 2009. Okay. Send down revenue includes 16 million for the goods sold. The company has recognized a total revenue of 16 million. Depending on 1st October 2008, the term of the sale are that the stand down will incur an ongoing service and support cost of 1.2 million per annum for the 3 years. So the cost, again, you can see the cost of the company is 1.2 million and having a gross profit percentage is 40%. So can you extrapolate the value of the sales from this cost price? Value of the sale from this cost price. So first calculate the value of the services. Very good. It should be divided by 60 and multiply by 100. So the amount will be 2 million for the first year. So here you can see the value of the goods and the value of the service has been combinedly sold at the value of 16 million, 16,000. And we have calculated the value of the services as 2,000 multiplied by 3 year service. So what will be the value of the goods? This amount minus this amount. Now the question is why we are not taking the percentages, because of the fact that we have not been given a standalone selling price. We have not been given a standalone selling price of the goods and services. So what we have done, we have been given a total bundle price of 16,000 and we have calculated the value of the service, which is 6,000. So the difference will be the value of the goods. So this amount should be recognized immediately. And this will be recognized over time. So on the day one, company should have to recognize by debiting the cash, crediting the sales, and crediting the deferred income. The amount of the income that we have not yet earned will be called deferred income. So we have received this amount of 16,000 from the sale of the goods, but we have only sold the goods at 1st October. And the remaining amount of 6,000 will be recognized as a deferred income, which is my liability. This is the date, 1st October 2008. Now what about the year end at 30th September 2009? At 30th September 2009, the 3 years out of the 3 year service of 3 years period, we have delivered the 1 year service. The accounting entry will be debit deferred income and crediting the value of the sales from the service. So this will be 2 million, 2000. So actually in the income statement, what revenue we should have to recognize? Revenue should be, we should have to recognize should be the value of the goods, which is 10,000, and the value of the services for the first year, which is 12,000. Now what about the deferred income? What will be the remaining amount left in the deferred income? Initially we have recognized a deferred income of 6,000, but we have earned a value of 2,000 from the deferred income. So the remaining amount of deferred income will be, deferred income has the nature of liability. So this is the answer. And out of this 4,000, 2,000 will be earned in the next year. So it will be reported as a current liability. 2,000, and the remaining will be reported as a non-current liability. 2,000. I'm sure you people are getting this point. If you have any confusions, you can ask it. Yes, if it was done in the mid of the year, then it would be proportionated. Starting from the initial phase, this question says that the value of the 1 year cost of the service, the value of the cost of this actually, the cost of the 1 year service is 1,200, and the company is charging a margin of 40%. So what we have to do is to divide the amount by 60, multiply by 100. So this is how we extrapolate the value of the sales. So for the 1 year, the cost price of the service is, the cost is 1,200 and the sales price is 2,000. But the company is providing 3 years service in this contract. So we have to multiply this with the value of 3. So we come to know this after multiplication, that out of this total bundle of 16,000, 6,000 is the value of the service. So remaining balancing figure will be the value of the goods. So the amount of the goods, as we have delivered the goods already and the performance obligation is satisfied, so we can recognize the value of the goods immediately. But initially we have not yet delivered any of the service at the start of the year, then the whole amount that we have received, advance revenue, should be recognized in the account of deferred income. Okay, and this deferred income will gradually be earned over the period of 3 years. So when the first year ends, we have earned first year's service, and the remaining amount left in the deferred income account is 4,000. So out of 6,000 we have earned 2,000, and the remaining 4,000 should be splitted between the current and non-current liability, because this, out of this 4,000, 2,000 will be earned in the future. So the liability that will be settled in the next 12 months should be reported in the current liability, and the liability which is settled in more than one accounting period should be reported as a non-current liability. I hope I have cleared the points. Wonderful. Okay, I'm just opening this handout section and opening the handout. This is my practice handout. You can see my practice handout in the handout section because we are doing section A, B, and the CRQ related to the final accounts simultaneously. It's not yet opened. I'm going to open this file. Okay. Can you see on the screen there are the questions related to past? Can you see the question on the screen? Yes. Now, this handout has 7 questions. If you solve all these 7 questions, you will be able to solve all type of final account questions. Now, please try to download this handout. Might be ACCA has emailed you this document. Now, this is the first note that we have already covered, that is related to IFRS 15 construction contract. All of you are required to do these notes, which I am right now marking here. So the name of the question is Dugan Company. Note number 1. Moving on towards the next handout. Next slide. Second question is Vernon. Note number 1. It is again related to IFRS 15. This is your assignment. So all of you are required to solve these assignments, which I am marking here. Note number 1, Vernon. Then we have Haverford, third question, in which you are required to do this adjustment, IFRS 15. You can see almost in all the past papers, you will find the adjustments of IFRS 15 in the CRQ area, and you will also find the adjustments in section A and B. So go and try it. Send down. This note is what we have already done. IFRS 15. So all of you are required. So by the end of this session, I will tell you some more questions which you have to attempt. This is again a question of IFRS 15. So these are the 7 questions that is the requirement of this practice to pass session. You can download these handouts from the handout section. On the right hand side, you will find a handout section. You have to click this handout section. Once you click this handout section, you will we're having two documents. One is the Word document, second one is the PowerPoint presentation. Is there a chance you can pass? You will pass the exams in this attempt. But if you follow all the instructions that I'm saying. So we have done this assignment. Now the next one is the sale and repurchase agreement. In the sale and repurchase agreement, actually this transaction has a repurchase concept. Then it means that IFRS 15 says that you cannot recognize this transaction as a sale transaction. The simple thing is it should be recognized as a loan transaction. And whenever you record a loan transaction, you have to book a finance cost of that as well. So just look at the question and make the accounting entry for this transaction. Again, I'm repeating the accounting treatment of this. Whenever there is a sale and repurchase agreement, you cannot recognize the sale in this particular transaction. All you need to do is to recognize the whole amount that you have received in the loan account. Okay. So please try to attempt this question. Can you read the message from here? Kindly reply. What sort of reply you want? Okay, there are a few students who want me to repeat the answers more than one time. I usually repeat the answers more than one time, two times or three times, but it's not possible for me to repeat more than four times, five times, and six times in this webinar because we have a shortage of time. So ACC will provide you uh, the video of this particular lecture, so you can see and repeat the video as much as you can. Right now, I can only repeat the answer maximum two times. Is this a revenue question? Yes, it's a revenue question. What is the difference between sale and leaseback and the sale and repurchase agreement? In the sale and leaseback, we are selling the property or selling the asset and lease it back. So this is a totally different concept in which we are taking back my property on the lease terms. But when we are doing a sale and repurchase, then it means that I am selling my product and I am buying it back. I'm not buying it back on the lease terms. I'm back on the cash terms. So the difference between is the cash and the credit. So did you people solve the question? Xavier sold its head office, which cost 10 million, to Zurich, a bank, for 10 million. Xavier has the option to repurchase the property on 31st December or 4 years later at 12 million. Xavier will continue to use the property as normal throughout the period and so responsible for the maintenance and insurance. The head office was valued at transfer on 1st June 2002 at 18 million and is expected to rise in the value over 4 years period. Okay. Now, what about normally when we sold the asset, the accounting entry will be cash debit 10 million and asset credit. Because we are selling at cost to cost, so there will be no profit. 10 million. Cash debit and asset credit 10 million. So as this transaction has sale and repurchase agreement, then accounting says that instead of recording this transaction in the sale asset account, you have to recognize a loan account of 10 million. So you cannot de-recognize the asset in this transaction. All you need to do is to book a loan instead of sale. Is it clear? No, it was actually agreed between these two parties that I am selling you at a profit and you will sell you at a profit or loss, and you will sell me at this price. So whatever be the difference I will have to pay in the future will be considered as a finance cost. So the additional amount that we have to pay in the future will be considered as my finance cost. So when the company is going to repurchase this asset, the price agreed between the two parties is 12 million. So the difference of 2 million will be considered as a finance cost. Is that clear? You say that he has option. Does it say that it will exercise option? The question saying it has option means that the loan, the sale transaction has a clear agreement that I'm selling you this property, and it has the option that I can. It's not the option which is optional. It's the option means that it's an option that I have to repurchase the asset back after 3 to 4 years. Giving the reasons show how the Xavier should record the above during the first year following the transfer. It is saying how you can justify the transaction. So you can simply justify the transaction because the control of the asset has not yet been transferred from the seller to the buyer. So you are selling the asset to someone, and its control is actually in your hand, because you have to repurchase this asset, and the buyer cannot use that asset according to his will. So that is the reason we are saying that because the control has not yet been transferred, so the risk and rewards is still left with the seller. So we cannot de-recognize the asset. So the whole amount that we have received should be recognized as revenue. Finance cost should be recognized as finance cost debit and payables credit. So moving on towards the next area. Commission sales. Commission sales is the arrangement in which you are working as an agent and you're selling your principal company's sales and you're charging a commission. So what's the matter here? Usually the agent recognize the sales of the principal company. So IFRS 15 says that this is not your revenue. Your revenue is only the extent of the commission that you have earned. The total amount of the sale that you have made on the basis of the principal company is not your sale. Okay, so you are only entitled to receive a commission. So you can only book the commission. So the question will always tell you that the company has recognized the whole of the revenue. You have to reverse the revenue and recognize your commission income. That's the simple case. Is that clear? Finance cost is a liability that will unwind over the contract. You will be having an unwinding only when there is a present value of the future cash flows. Okay. Rosemary companies includes 2 million for the goods. It's sold acting as an agent. So we are actually working as an agent of Elaine company. Rosemary company earned a commission of 20% on the sales and emitted a difference of 1.6 million, including a cost of sales to Elaine company. So what the Rosemary has done, actually, they made two accounting entries. The first one is they have debited the cash. How much amount? Of 2 million. 2 million. And crediting the sales at 2000, which is not your sales actually. You are only entitled to receive a commission. And then subsequently, they have paid the amount to the alien company. So the accounting entry they have made is they have charged 1600 in the cost of sales. 1600 in the cost of sales. Credit in the cash. This is what they have done. But what accounting entry should Rosemary should have to record according to IFRS 15? As you are a commission agent, you are only entitled to receive a commission. So you can record this transaction by debiting the cash, crediting the sales. You have only earned a commission of 20%, which is 400, and you have to record a liability. This is what Rosemary should have to record of 1600. And out of this, Rosemary has paid 1600. The second entry should be liability debit 1600, cash credit 1600. So now I'm reading these two entries. What is the meaning of these two entries? What it has and what the company is showing actually. Now, company is saying that we have made a sale of 2000 and receiving a cash of 2000. And previously we have bought these transactions where we have bought this inventory for 1600. So we have buy the inventory for 1600 and sold it for 2000, which is saying that the company is doing a trading business. So do the Rosemary is doing the trading? So the answer is no. Rosemary is not actually trading. It is not actually buying and selling its products. It is working on the behalf of its principal company as an agent. So what should be the treatment? Now see these entries. Like you have received an amount of 2000 in which you can only recognize your sales, which is your commission income of 400, and the remaining amount is your liability which you have to pay to the principal company. principal company. And once you have paid the liability, your liability is finally settled. And in your books, you can only recognize the sales of 400. But here you can see the company is recognizing a sales of 2000. So all you need to do is to adjust this transaction. So what will be the adjusting entry? Can you make the adjusting entry for this transaction? What should be the adjusting entry for this transaction? Very good. Debit sales by 1600, crediting cost of goods sold by 1600. Very right. Sales should be debited by 1600 and cost of goods sold should be credited by 1600. Very good. Perfect. Sales debit by 1600 and cost of goods sold should be credited by 1600. We are still here on IFRS 15. Now moving towards the next point. Now, financial instruments. We have three standards for financial instruments. One is IS 32, other one is IFRS 9 and IFRS 7. We have three accounting standards which are examinable in the paper. Adjusting entry. The adjusting entry should be debit sales 1600, credit cost of goods sold 1600. So this will be the adjusting entry for this transaction. Okay, we have missed something. Okay, this slide was missed by me. Sale and return basis, the treatment is very simple. When we sold the goods on sale or return basis and we have not yet received the confirmation from the buyer, then accounting says that you cannot recognize the sales. But the question will always tell you that we have recognized the sales already. So all you need to do is to reverse the sales. So you cannot recognize the sale of goods which has been sold on sale or return basis. So if you have sold the goods on sale or return basis, you have to reverse the amount of the sales and add the cost of these goods in the closing inventory. So these are the two adjustments that we should have to make. I'm repeating the adjustments. First, we have to reverse the sales. First, we have to reverse the sales and the cost of the inventory should be added in the closing stock. Okay. Actually, accounting says that if you sold the goods on sale or return basis, you cannot recognize a sale. But the question will tell you the company has recognized the sales of, say, for example, 1000, receivables debit sales credit 1000. All you need to do is to reverse the amount of the sales. So the adjusting entry should be debit sales 1000 and credit receivables 1000. That's it. So if you have sold the goods on sale or return basis, you cannot recognize the sales unless the buyer will give you the confirmation that they are going to buy the goods. And whatever be the cost of this good should be added in the closing stock. The cost of this goods should be added in the closing stock. These are the two treatments that we have to make. Now in this question you can see the sales revenue includes 50 million. Company has already recorded 50 million in the sales account, which have made on the sale or return basis at a gross profit margin of 40%. The customer has not yet confirmed that they will pay the goods or not. If the customer has not yet confirmed you that they are going to pay the goods for the goods, you cannot recognize the sales. So all you need to do is to reverse the transaction. So the accounting entry should be sales debit, receivables credit, and the cost of these goods should be added in the closing stock. So in this question, you will always be given a gross profit margin or markup. So using this percentage, you can calculate the cost of the goods, which should be included and added in the closing stock. I hope I have cleared this point. So moving towards the financial instruments. Financial instruments is actually contracts that give rise to financial asset of one entity or financial liability or equity instrument of another entity. So whenever we are discussing about the financial instruments, it means that we have a contract in which one party is creating financial asset and the other party is creating the financial liability or the equity instruments. Now, what are the financial assets? Financial assets are actually assets, but in order to become a financial asset, it has to meet the definition of IAS 32. IAS 32 has mentioned there are 4 types of financial assets out of the total list of assets that we have. So cash, the financial assets, equity instrument of another entity means the shares of another entity in which we have done some investments. Contractual right to receive cash. Contractual right to receive cash means debtors or loan assets in which we have to receive the cash based on the contract. And contractual right to exchange financial as financial liability potentially favorable. If we have some derivative assets, then it will be considered as financial asset. Financial liability has a contractual obligation to deliver cash. So this is actually the thing which differentiates it from the equity instrument. So what is the difference between the equity and the financial liability? In the equity instrument, you do not have to pay back the amount. But in the financial liability, you have to return the amount to its provider. So this is the basic difference between financial liability and equity instrument. So this is actually connected with the preference shares. We have 2 types of preference shares. The first one is the redeemable and the other one is the irredeemable preference shares. So in the redeemable preference shares, there is a contractual obligation to pay back the amount that we have received after some time. So we always classify redeemable preference shares into financial liability and irredeemable preference shares into equity. Are you getting my point? Now, what are derivative assets? Derivative assets are actually contracts whose value is dependent on some underlying market related items and it will be settled in the future. So if the contract is favorable for you, then it will be your derivative asset. But if your contract is unfavorable for you, then it will be the derivative liability. Okay. Is that clear? No, sir. Oh, no, sir. What is not clear? Derivative is not clear. Okay. I'm giving you an example. I don't know from which country you people have taking this uh, prepare to pass sessions, but in my country, when we are going to buy £1, British pound, we have to pay 200 rupees roughly. So 200 rupees, in 200 rupees we got the £1. Okay, to 10. So the students from Pakistan will understand this point, that we have to incur more than 200 rupees to get £1. Suppose I know I want £1,000 in the future. I want £1,000 in the future, and I'm at risk that the value of the pound might increase in the future. So I have locked the price of the pound at a value of 210. So with someone I have agreed to purchase, say for example, after 3 months, I will purchase £1,000 from you, £1,000 from you at a price of 210. Okay. Right now the price is 200, and I have locked the price at a value of 210. So now after 1 month, 2 months, and 3 months, when the 3 months has spent, after 3 months, I have to close this contract. And I know that the market value of each pound right now is 210. Now tell me whether this contract is going to give me the benefit or not. If the value of the pound after 3 months is 210, 220, and I can buy the pounds, £1,000 in the value of 210. So whether you think that this contract is going to give you the benefit in the future, yes, definitely. This contract is giving me the benefit that I can buy the pounds at the value of 210, whereas the market value is 220. So for every pound, I'm going to save 10 rupees. So what will be my saving? My saving will be, after 3 months, 10 into 1,000. This is my saving. So accounting says that you have to recognize a derivative asset at a value of this price. But what about the other party who make the contract with me? He is going to lose 10 rupees for every pound, because he has to give me the pound, and the market rate of each pound is 220. He will buy the pounds for me at a price of 220 and then give it to me at a price of 210. For every pound, he is going to lose 10 rupees. So this will be his financial liability, derivative liability. So I am the beneficiary of this transaction. I will book a financial asset, and he is the loser in this transaction. Now what if the value of the pound is 180 after 3 months? So if the value of the pound is 180 and I have to buy the pound at the value of 210, then I will be the loser. For every pound, I have to make a loss of how much amount? 30 rupees. So I have to recognize a derivative liability. So sometimes it will be my derivative asset or sometimes it will be my derivative liability. Now what about the other party? The other party who has to provide me 1,000 pounds is going happily to the market and buy the pounds at a price of 180 and going to sell me at a price of 210. So for every single pound, he is earning a price of 10. So sometimes this contract is favorable for me and sometimes this contract is unfavorable for me depending on the market price. So this is called derivative assets and derivative liability. I hope I have cleared this point. Okay. So this is the definition. So I'm moving towards the treatment of these. Now, financial liability, financial instruments has financial assets, financial liabilities. Financial assets has two instruments. First is the debt investment, second one is the equity investments. So we can place the financial assets financial asset has two categories in our course, the debt investments and the equity investments. So for the equity investment, we have two categories, and for the debt investment, we have three classification categories. And we have a financial liability in my course and financial liabilities measurement, how we can measure, which is in the scope of IFRS 9. So let's discuss the concept of financial asset. Let's discuss the concept of financial assets. Financial assets might include equity instrument. Equity instrument can be measured at fair value through P&L or fair value through OCI. These are the two categories. What does the fair value mean? Fair value means that you have to measure the instrument at the market value, initially and subsequently. So if there is a gain or loss arises on the measurement at the each reporting date, it should be recognized in P&L. But if there's a gain or loss arise on the fair value measurement, it should be recognized in OCI. So whatever we recognize in the P&L should be reported in the balance sheet in the retained earnings. And whatever we do recognize in OCI should be reported in the balance sheet in OCE, other component of equity. So this is the P&L position, this is the balance sheet position. Now, what is the criteria that how we can measure the equity instrument is favorable through P&L and favorable through OCI? So do remember this point. This is the default position. Default means you can place all type of equity instruments into this category, favorable through P&L. This position is irrevocable. And this position is for the equity instrument which we have to hold for long term. Irrevocable means that once you have placed the equity investment into OCI category, you cannot change its classification from OCI to P&L. This is now locked in this category. once this option is exercised. But if you have shares which is held for trading means you are buying the shares and selling the shares regular basis, such as buying and selling, then it should be classified in fair value through P&L category. Now, what about the measurement? In this category, you have to add the transaction cost. So in this category, you have to add the transaction cost. Transaction cost should be added in this category. So whatever the cost of the shares, you have to add the transaction cost. But in this category, transaction cost should be recognized as an expense. So simply we capitalize the transaction cost in this category and we charge as an expense. So if in the question, if nothing is mentioned that what the company has done, then it is assumed that it should be measured at fair value through P&L. But if the question specifically says that the company has exercised this option, so then you can measure the equity investments at this value. OCE means other component of equity. Session will end at 12. So there are people who I think are tired. So if you wanted to leave, you can leave, but you have to continue the session till 12. So I'm giving you the question for which you are required to solve it. Now, this is a question for you guys. This is one of the questions which the examiner says that most of the students are giving the wrong answers of this question. So now it's your turn to attempt it. It's an exam question. Give your answer. Other component of equity means other component of equity is one of the equity account in which we recognizes the gains and losses. It is one of the reserve account, but it can only take the gains and losses from OCI category. And is there any WhatsApp? Yeah, we do have a WhatsApp group. You can just message me on my number. You can send me the message and I will add you on the group. Now, what will be the answer of this question? A, B, C, D. A, B, C, D. Is it A, B, C, or D? Now, correct answer is A. A is the correct answer. So, do you people want me to explain? Now, initially, company has acquired 9,000 shares at a price of 6.4 per share and incurring a transaction cost of 9,000. Taunton elected to hold the shares at a fair value through other comprehensive income. At 31st December 2003, the fair value of the POCO shares was 7.5 per share and selling costs were expected to be 4%. So IFRS says that you have to recognize and measure the financial instruments at fair value. So we never use the selling cost. So what is the value of the POCO shares in terms of individual financial statements? So what will be the value? So the value of these shares is now 7.25 into 9,000. That's so simple. 9,000 shares into 7.25. But if the question will tell you the exact gain that you should have to recognize in the OCI, so then we have to do some calculations. Now currently we have acquired 9,000 shares at a value of 6.4 plus 9,000, 6.4 plus 9,000, because in OCI we capitalized the value of finance transaction cost. So this is the total value of at which we have recognized the shares immediately. Now these shares has now have a cost of 7.25 into 9,000. So the total value is now 65,250. So if the question will ask you to calculate the gain or loss, so we have suffered a loss of this amount minus this amount, 1350, which should be recognized in OCI. So if the examiner will ask you to recognize the gain or loss, then it should be calculated like this. Is that clear? Why didn't we add the transaction cost in this? Transaction cost was initially capitalized initially only. So we only have to add the transaction cost when we are purchasing the shares. But subsequently, we only have to report the shares at the number of shares into the current market value. So this is why most of the students will not be able to answer the question. What will be the entry for the loss? The entry will be OCI debit and investment credit. OCI debit and investment credit. Now moving towards the next point, that is debt instrument. Debt instrument. Do remember this point, we are discussing financial assets, because usually people understand debt means liability. So it's not a liability. We are working on the financial asset. So it is actually the provider of the loan. The party who is giving the loan to someone will be recognized a financial asset, and the party who is borrowing the amount of the loan will record a financial liability. Now, so we are talking about the debt asset. How we can identify the exam? If the examiner will tell you the company has issued, issued debt instruments, the debentures, then it means it's a financial liability. But if the question says to you that if the company has purchased the debt instruments or debentures, then it will be a financial asset. So if the company has purchased the debenture, then it means it's a financial asset, debt instrument. If the company has issued a debenture, it means it's a financial liability. Now, debt instruments can be measured at amortized cost. Same financial liability can be measured at amortized cost. It is a default position, means all can be placed here, but for placing the debt financial asset into amortized cost method, you have to pass the test. One is the business model test. Second one is the cash flow test. So if the business model test is passed, then and the cash flow test, both tests will be passed, then you can place the debt instrument financial assets at amortized cost. But if the test is failed, then you cannot place the debt instrument into this category. Okay. Now, what is the meaning of business model test pass? Business model test pass when the company has to hold the debentures till maturity. And cash flow test will be passed when you have to receive only principal and interest amount. Principal and interest amount from this instrument. So if both the tests pass, then it should be measured at the amortized cost. Now, how we measure that at amortized cost? We have to make an amortization table. Financial asset at start. Then we have to book an interest. Then the receipts. Receipt should be deducted from here. And then finally, we have to report the financial asset. Then, clear? What about the measurement of the financial liability? if it is measured in amortized cost, year one, the party who is borrowing the loan will recognize the obligation at start plus interest minus payments, and then finally obligation return. So the company who is giving the loan will recognize the financial asset like banks, and the companies who is borrowing the loans will recognize the financial liability like here. But in order to measure the financial assets at amortized cost model, you have to pass two tests. But in order to place the financial liability into amortized cost, there is no test. It's a default position. Default position. Don't need any sort of test. You only have to measure it at amortized cost. Okay. Yeah, it's very much similar to the lease. Now, how we can measure the obligation at start when we are measuring the financial liability initially. So obligation at start will be measured at the par value less issue cost and discount. Par value less issue cost and discount. These two should be deducted from here. Then interest will be charged and payment will be made. Interest will always be recognized at effective rate. Payment will always be made at par value. And then we got the value of obligation return. Similarly, when we book the financial asset, par value plus. Do you remember this? Here we have to add the issue cost. Issue cost should be added here, and issue cost should be deducted from the financial liability. So this is the very important point that you should have to understand. I hope you people are getting. Test name is business model test and cash flow test. So do you have any question in this portion? So do ask. No? So I'm giving you two questions for the practice right now. One is for the financial asset. Interest should be calculated on the effective rate. Principal amount is the actual amount of the loan that we have provided, and the receipt means the payment that we have received over the period. Like sometimes the borrower will pay you only the interest amount, or sometimes it pays you the interest plus the capital repayment. Effective rate for both financial asset and financial liability, yes. So I think let's try to attempt a question in which you have to identify whether it is a question of financial asset or financial liability. So I'm giving you now, read this question and identify whether it is a case of financial asset or financial liability. whether this case is for the financial asset or financial liability. Yes, company has acquired your purchase means the company has provided the loan to someone. So it is actually financial asset. Very good. Very good. It's a financial asset case. So do remember this point, when you are measuring the financial asset at amortized cost, you have to capitalize the transaction cost using the amortization table. So just make the table for the first year and calculate the interest income or the finance income and balance sheet value using the table. What will be the finance income? The time is passing. It's 2 minutes already. Did you people have calculated the amount? Now let's solve it. Company has acquired 9 million 5% bonds at a par value on 1st January 2008. The interest is receivable on 31st December each year. And non includes 0.4 million brokerage fees when acquiring the bonds, which has been expense to operating expense. This is a wrong treatment. You also have to do the adjustment in operating expenses when you are attempting the full question. These bonds are repayable at a premium, so have an effective rate of 8%. A non-company has recorded the interest received and on 31st December 2008 in the investment income. Now starting from here, the financial asset at start should be 9,000 plus 400 is the issue cost. So 9,400 will be the value. And investment income will be calculated at 8%, 0.08. And the payment will be made at the par value, which is 9,000 into 5%. And the financial asset at end should be 9,400 plus 752 minus 450. So 9702 will be the value of the financial asset, and the interest income that we should have to recognize is 752. So why is charging the broker? Yeah, this is the wrong treatment actually in the question. So examiner wants you to correct this when you are attempting the whole question. So where do we treat? We have capitalized the brokerage fees. So we have added the brokerage fee here. You can see here, I have added the brokerage fee here. It's 450. As I have said that whenever you are calculating the receipt or the payments, it will always be based on the par value of the bonds into the nominal rate of interest which has been given to us, which is 5%. The rate which is attached with the bond instrument is called the nominal rate, and there will be an additional interest rate which will be given to you, will be the effective rate. Effective rate will always be higher than nominal rate. Uncapitalized and not unjust bonds. This is actually the requirement of the standard and we are following. I can only teach you in this session how to solve. We cannot go in the conceptual details of the accounting standards because it will take almost 1 day complete to deliver at least one accounting standard. I think yeah, this is amortization method. So this is the amortization method for the financial asset. Now I'm giving you the question. For the financial liability. Now attempt this question. This question says that the entity issues 4% loan notes. If the company is issuing the loan notes, then it means the company is borrowing actually. So this is the case of financial liability. Please do attempt it. I think this will be our last question. This will probably be the last question of the session. Please do attempt it and apply your answer very quickly. Is it done? Please reply your answer in the chat box. It's a case of financial liability. Very good. And how we are going to measure it? What will be the interest amount? If there's a discount in the financial asset, then it should also be deducted. But the transaction cost should be capitalized in the financial assets. The 10% percentage is having no use. Actually, it was saying just that you have to redeem the loan at a premium of 10%. So it will not going to be used because the value of the premium is already embedded in the effective rate. So your main focus should be on the effective rate. So there is actually a issue cost of 2.5% and a discount of issue cost of 534 and a discount of 2.5%. So let's solve it. The par value of the loan is 20,000. Issue cost is 534. If I'm not wrong, Yes, and the discount is 2.5%. So what will be my financial liability at start? By deducting these two figures, we got the value of 18966. Interest will be charged on effective rate, which is 0.07%. But do remember this point, the payment will also always have to be made at the par value of the loan, which is 20,000 into nominal rate, which is 0.04. So the value of the obligation will be, and there is a one point of the warning that you should remember, that whenever we are calculating the interest, always see that whether there's a 12 months it has been covered or not. So if the 12 months period has been covered, then you can take the full amount. Otherwise, you have to proportionate the interest value. So do we have been given any time period in this question? No, we have not yet been given the time period. So the first requirement is what amount will be the recorded as a financial liability when the loan notes are issued. So initially, the financial liability should be recorded at 18,966. The second requirement is what will be shown in the income statement. Income statement, we will report a finance cost of 1327.62. And in the balance sheet, we have to report this amount as a non-current liability. Do remember this, whenever we are doing financial instruments case, you do not need to break the liabilities into current and non-current. So this is how payment will always be calculated at the par value. So 80,000 is calculated as 20,000 into nominal rate, which has been given to us in the question, which is 4%. So this is how we have calculated. Is that clear to all of you? What to do with the discount in the financial asset? If we have received a discount in the exam question related to the financial asset, then it should be deducted. Is this clear to all of you? Okay, that's great. How will you get the 500? 500 is a 2.5% value, which is the value of the discount. This is 2.5% value of discount. And this is my issue cost. You can see in the question, it says that the issue cost is 2.5%. So we have calculated 2.5% of the 20,000. I hope I have delivered the concept. If you are still confused in any of the topic that we have covered today, I think you can take my video lectures and you can find these video lectures very easy to use. Then that's actually, I think, a luxury for you. You can review the lectures as many times as you can. So I think the time is over now. Please give your valuable feedback about the session, any suggestions that you want me to cover. Tomorrow will be the day of the final account with some key accounting standards. Tomorrow our class will be on CRQ. We will be focusing on the constructive response questions after doing just two adjustments. The first one is IS related to the taxation, IS 12, and then one of the concept of financial instruments is compound instrument. So when we cover these two concepts, then we will focus on the constructive CRQ area. So We'll be doing these questions from the handout of day 1, day 2, and day 3. And please do WhatsApp me if you wanted to join our WhatsApp group. And I request all the students to share whatever resources that you have for the preparation of financial reporting in the WhatsApp group. And especially, I do recommend those students. Uh, I do recommend those students who got failed previously in this paper. Please do contact me personally. I will have a unique and different plan for you guys. If you follow my plan, you will definitely pass the paper in this attempt. For WhatsApp group, you have to send me a message. I'm sharing my number here. 00923323. So this is my number. I request all of you to please do revise the topics that we have covered on a daily basis and try to attempt MCQs from the Kaplan and BVPK related to these topics. And if you are facing or finding any problem, you can share your query on the WhatsApp group, or you can even directly ask me. Okay? Please give your feedback and suggestions about the sessions, because feedback will be considered as a petrol for the tutor. So it will be like work as a high octane actually, whenever you give your feedback, valuable feedback. So I want the honest feedback from you guys. So see you tomorrow to 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 take very good care of yourself. So see you tomorrow at the time 8:30 sharp. Thank you so much for your feedback. Inshallah, we will meet tomorrow. Take care. Allah Hafiz. Bye bye.